The U.S. added 157,000 jobs last month, below expectations. Unemployment rate did go to 3.9, closing in on its lowest level in 50 years. Joining us exclusively today, Goldman's chief economist, Hatzius, is here at Post 9. Jan, good to have you. Welcome.
Nice to be here.
You say given the combination of the revisions and then this Toys R Us wrinkle, which we talked about earlier this morning, you think the report indicates a faster underlying rate of growth?
Well, yeah, I think the averages have picked up. I mean, both the 3-month and the 6-month are now above 220K. And if you add, something for this one-off factor in Toys R Us, then I think it's very rapid payroll growth. You look at the household survey, and the drop in the unemployment rate was due to very strong household employment growth. It wasn't due to weaker labor force participation. So this is a firm report, I think.
And July is historically weak, as I understand?
Well, yeah, although they do seasonally adjust these things, so I would tend to take this at face value in terms of the seasonal adjustment.
Interesting. So, and then moving to wages, your take on that today, 2.7.
No real news on that. It was a little stronger than we thought. We had expected a bit more of a negative calendar effect. So if you adjust for the timing of the survey week in the month, maybe it's a little stronger, but nothing major, I think, in terms of the wage numbers. Overall, I think what we're looking at here is still a very strong job market, very rapid employment growth, far above the underlying trend that's needed to stabilize the unemployment rate, which is in the low 100s, but wage pressure is still fairly limited.
10-year yield went back above 3% this week. It's now sitting below that. If you ask people, what does that tell you? You get 100 different answers. How do you answer that question as it relates to the U.S. economy?
I mean, I think it has moved higher over the last couple of years as the economy has strengthened. That said, I think you look at the long term, the term premium at the long end of the curve is still very depressed. Central banks around the world are still buying. The Bank of Japan still running a very easy monetary policy. The ECB hasn't stopped the purchases yet. I think all of that has something to do with the very flat curve and the very low term premium at the long end. But we have seen increases that have been pretty sizable relative to where we were back in 2016.